Well, Stephen's discussion of the resources boom probably is a good segue into my interview with Nev Power, the CEO of Fortescue Metals Group. I spoke to him earlier in the week. Well, Nev Power, have you applied for an enterprise migration agreement?
Alan, we haven't. We've had no problem recruiting people at this stage. Every time we've advertised for people, we've been able to recruit from the Australian market.
All Australian workers and no one on 457 visas?
Oh, we have a few people on 457 visas where some of our construction companies have brought in specialists. So we'd have a number of people that would be here on 457s, but there's been no major program to bring them in.
And what about when you're in full operational mode? Do you think you'll be able to staff the business on all Australian workers then?
Yeah, we're very confident about doing that, Alan. Of course, we'd keep an eye on that and we wouldn't discount using an EMA if we needed to in the future, but we don't see any need for that at this stage.
So what do you think about this argument that's going on about EMAs at the moment?
Well, look, I think it is important that the resources are there to allow the construction phase for these mining projects. So our development has been early enough in the phase that we've been able to get all the workers that we need. So it's up to the individual companies to assess whether they can get enough workers out of the Australian market or whether they have to do something like that.
The other thing that occurred this week is on the political side of things was Julia Gillard saying that, you know, it's not your minerals. The community owns them. What did you think of that?
Well, Alan, we agree that these minerals belong to all of Australians, but as a mining company, we've put up all of the risk capital to develop those. We've been granted the mining licences, and a tremendous amount of the benefit that comes from those mineral resources are flowing back to Australia. The vast majority of what we earn in export revenue goes back to pay wages, to employ local companies, goes into local communities. And even the amount that comes out as profits from a Fortescue point of view, we've reinvested many times over our profits in developing future supply. So the multiplier effect is quite significant and is benefiting all Australians.
And what's your effective tax rate going to be, including royalties and the MRRT?
Well, if you take our tax, we've been in a development phase up until now. So, of course, we've had the deductions that have been able to apply to our tax. But in 2012, we'll pay around $600 million worth of tax, and that'll rise to $1.2 billion next year.
Well, what percentage is that?
So eventually, we'll pay the 30% company tax rate, as all companies do once you reach that sustainable profit level. In terms of MRRT, we don't see any significant tax payable in the near term at all from the MRRT. And that's because of the deductibility base that's allowed in that legislation.
When do you think you'll start paying MRRT?
Well, at this stage, we've forecast forward for the next 2 or 3 years, and it's a negligible amount through that period of time. So it does depend on the iron ore price. As the iron ore price goes up, that tax liability goes up. But at these iron ore prices, I don't see us paying any.
So in the light of that, what do you think of Wayne Swan's forecasts for MRRT revenue, which are in the billions, several billion?
Well, one of the difficulties with this, Alan, is Treasury have never released the modelling or the forecast that they've got for that. So it's very, very hard to see how they're coming up with their numbers. But we see that that's going to be very difficult for them to achieve those revenues.
Now, you must be feeling a bit nervous about what's going on in Europe at the moment. About a week ago, your chairman, Andrew Forrest, said it's all a storm in a teacup, beaten up by the media. Do you still think that?
Well, look, I think the issues in Europe have had a very strong effect around the global economies, and probably far more than what you would expect. So the difficulty there is that, yes, they're in trouble over there in those economies, but if you take the sum total of the impact of those economies, say on China and Australia, they're relatively small, but the equity markets have been hit very, very hard in comparison to that effect. So what Andrew was talking about was that the fact that the equity markets had been spooked by Europe far greater than the actual physical impacts.
But what matters to you, of course, is the iron ore price.
Yes.
What price have you got in your forward planning, in your budgeting?
Well, we see in the short term that it'll trade in that range, $130 to $150 a tonne, and it has been very resilient over the last 12 months or so, trading around that range. But looking forward, we've allowed the forecast to drop down to around $110 a tonne and done all our modelling around that. So we see that long term, that'll be the sustainable price.
But in the 2008 crisis, it got down to as low as $55 a tonne. So if there's another crisis, this is what I'm talking about you feeling a bit nervous. I mean, if there's another crisis coming out of Spain collapsing or Greece or whatever, you can see the price go down to that level again.
Well, Alan, it did go down to a little under $60 a tonne, but that was for a sort of fleeting moment, and it recovered to over $100 a tonne within weeks. And then that was a global financial crisis. That was a real global crisis.
But the reason it recovered so quickly was the Chinese economy recovered so quickly, and right now it's slowing.
Well, Alan, the Chinese economy is going through short-term fluctuations, but overall it's growing very strongly. It's growing in that 7 to 8% range, which reflects back to a 4 or 5% growth in steel, which we see as really strong growth, and something I think a lot of countries would aspire to.
Thanks very much for joining us, Nev Power.
Thank you, Alan. It's good to be here.